My guest today is Xavier Helgesen, founder and managing director at Enduring Ventures, a long-term holding company where they buy beautiful businesses and hold them forever. Xavier has founded 6 venture-backed businesses, acquired 24 companies, sold 2 businesses, and raised over 300 million in debt and equity. Thanks a lot for coming to the HoldCo Builder show.
Thanks, Mick. It's a real pleasure to be here. I've appreciated your posts on X for a while, and so it's fun to get to know you.
You're an excellent person to talk to because there are so many people, more than ever, who want to acquire a business and build their own holding company. But the main reason I wanted to talk to you is pretty much 2 things. Number one, your memo to your 25-year-old self, which you posted on your birthday. And number 2, the list of everything you know about buying businesses and looking at 1,000 different companies pretty much. And I want to cover it all on this podcast.
Okay, well that should keep us busy. And I saw you had printed out that birthday post, and that really made my day when I saw you.
Yes, I'm going through it once every 3 months. I can be around. Yeah, every 90 days I'm reading this because it's good stuff, but let's cover it. And if that works, I will read them to you one by one. And after each, you'll just share your thoughts, experience, and maybe what you mean. And if there's nothing to add, just let me know. Sounds good?
Perfect.
Okay, number 1. Most bad things that happen to you are not as important as they feel at the time. You can make more money, fall in love again, or start a new company. You can't recover time or health lost stressing about what went wrong.
Yeah, so that's probably, if there's one lesson like I've learned that I could put on a billboard, I wish everyone would realize. I mean, I've had 2 divorces. I had a house that I bought fall apart from the inside that was had toxic mold in it. I've had business startup companies I started almost fail or almost have their loans called on them. I'm sure I'll get into plenty of more messes with all the businesses we have now. And I just think I think people get really attached to the way things are presently in their life, especially if they have a little money or they have a little wealth, and we have this incredible fear of loss. And I think, frankly, it's overstated. If your kids go to the private school and you go vacation in Europe or Africa every summer or whatever you do, and you can't do that, I mean, the kids are fine. They just really want time with their parents. But what they don't want is to have a stressed out, angry, father or mother who is losing their hair and losing their health and, losing their mind over some economic matter, some business matter. I've known plenty of people who've declared bankruptcy, who've lost it all, and who've been just fine. And so this is a high stakes game we play in the business buying world, and entrepreneurship in general. And I think it's very important to stay grounded that good things may happen and bad things may happen, and that's the game you've chosen to play.
Number 2, keep being a kid at heart. Say yes when people invite you to a Burning Man. Make friends with people younger than you and older than you. Push yourself outside your comfort zone.
Yeah, I think the single dumbest thing I did not do in my early 20s was I didn't go to Burning Man when all the hippest, most interesting people I knew said you should come to Burning Man. And so now I'm a part of that community, and it's probably one of the things I look forward to the most out of the year. There's people think it's just another festival, but if they haven't been, but it's really something very, very different that I've never experienced anywhere else, and it's an incredibly good time. So I also I try to just take time to play too, just with kids and with dogs and with sports, because we can get in our head too much and out of our body. And that's probably another thing. I would say I probably worked too hard in my 20s, to be honest. And I'm not sure, I missed a lot of good playtime by doing so.
Every year, take 10% of your income, even if it's not much, and buy stock in companies you understand and believe in. Never sell unless management changes or some bozo takes over. Prices that look high now will look ridiculously cheap in 10 years. I sold Apple and Nvidia in 2011 and Google in 2008. Don't be me.
there's probably nothing that hurts more than knowing that I had that Nvidia stock when it was a 10 billion market cap, and I thought it was a great company with great management. And even then, they were talking about self-driving cars and AI. They had a clear vision of where this was all going to go. And I don't know. I was doing something in my life, and I wanted to free up some money, so I sold stocks, and and I thought, oh, no big deal. I'm an entrepreneur. I will. I have one more reflection, which is I started one of the largest Amazon third-party sellers in the very early days of Amazon Marketplace. And if I could do that all over again, all I would have done is run that for cash flow and buy Amazon stock, because I saw from the inside how good of a business Amazon was and how much it was growing. I was very much closer to that than almost anyone else. And I didn't have that mindset at that point that I could run the business for cash flow, and I would be better off investing in the big company I saw working. Like, I'm better off buying a little bit of whatever Jeff Bezos is doing rather than like owning a large part of what I'm doing, because I'm not Jeff Bezos, I don't have that machine that Amazon had already built. So I think about that a lot, especially when you're like, if you're an engineer, you're deep in the plumbing, you can see what the really good tools are, what the really good platforms are. If you are a finance person, I mean, there's never a bad day to buy Berkshire. I think it's still undervalued. It's or just a company you understand. Like, I'm a big believer in Tesla in the long run, because my car drives me places. It does it today, and it actually works. And I haven't seen any other car company come remotely close to that. And I think that autonomy is going to be the most fundamental technology of transportation in the coming decades. So so I still try to do that whenever I can. And then I think the key is just to not sell, which is harder than it sounds.
Keep traveling like crazy. Keep exploring the world wherever your curiosity takes you. If you need more money to keep going, figure it out. You are resourceful. Find a way to work from wherever you are in the world. There will be time to make more money later on, but you may never again have this level of freedom and flexibility.
Yeah, so just as an example, I'm going to Europe this summer. I love Europe. I had to book 5 plane tickets, and that doesn't count the infant, because my 2 older kids, my fiance, grandma to take care of the baby, and then the baby's going to sit on our lap, right? And so whenever you're booking 5 plane tickets, that's a good. And I've got to find someone to take care of the dogs. I've got to find someone to house sit. So you have all this stuff that you build up as you go, and you want to have it. I love going to Europe with my kids, but God, it is not the same as like being 25 and being able to just go to Japan for 3 months or whatever. I remember one point I was traveling, and I was working at this Italian hostel for a month, just trading for room and board, and it was like, God, it's the most blissful month I've had in a long time. I didn't have any responsibilities. I didn't. Maybe I spent a little bit to eat out every once in a while, but my burn rate was probably $300 that month, and I was living in Tuscany, so it was great.
Next one, lift weights, find the sport you love, sauna, cold plunge regularly, run consistently 3 times a week, regardless of amount.
Yeah, I think what I've learned is the consistency for physical activity just matters a lot more than the maximal exertion. It's a young man's game to try to say, oh, I can bench my 1.5 times my weight or something like that. Maybe you can, maybe you can't. If you can, good for you. But I think it's far more important just to get your body moving on a regular basis, especially when you're busy. I just find my mind is so much clearer, and I just do much better work if I'm actually in motion. And I found that, running is the great equalizer, because it doesn't matter where you are in the world, doesn't matter what the weather is. Put on the shoes, go out the door, go some direction, 1 mile, 2 mile, 3 miles, turn around, come back. You can do that every day, anywhere. You don't need any equipment. It's incredibly, and it's usually very enjoyable.
Number 6, your choice of romantic partner will be the single most important decision in your life. Treat it as such. Whoever you choose, know that the real work starts when you say yes. Every great relationship takes as much work as a great startup.
Yeah, this is probably, having had 2 marriages not work out, actually both to wonderful women who are still involved in my life in one way or another. First one being to the mother of my two older children. I think I approached them with an entrepreneur's optimism and enthusiasm of like, okay, we'll dive in, we'll figure it out. Like, we'll just, anything's hard, we'll just work through it. And I think, just building a relationship is a different skill set and a different amount of work and a different amount of really rigor and thoughtfulness. You got to be really honest about who you are as a person as well to figure out who you might be a good partner with. Do you have a partner, Nick?
Yes, and a small kid, second one coming soon.
Ladies of the internet, he's taken. It's too late. It's amazing. So, what have you learned from having young kids?
From kids, it's all about patience, and which I probably didn't have like a year ago, that much as much I have now, and it really helps, I think, in building a company as well. And when it comes to my girlfriend, just super happy that I found her before. I believe this true success comes when it comes to money. Let's put it in this way, as this podcast is about money oftentimes. And she's on the same page with me. And if we take this evening, for example, it's 8:30 p.m. in here. It's 27 degrees. She wanted to have a dinner today, and I said that I'm having this podcast, and she said that, okay, that's fine. Do your stuff. I pretty much believe in you, and keep going. Let's do the dinner tomorrow. And the fact that I don't need to sell her that I have to do those things, this makes me very happy and very grateful that I met her.
Yeah, she sounds wonderful. I think women are like the great venture capitalists in their choice of men. They are willing to see the potential in a man and make their bet. And I think I'm engaged to be married for a third time, and it's certain will be the last one. Put a lot of work and thought into this relationship, and she's incredibly wise and kind woman. And I found that actually really taking her on the journey with me, it really matters. I think there's an instinct to like, oh, well, the hard stuff at work, I'm just going to keep that to myself. I don't need to trouble her with it. And it actually is sort of the opposite. Like, she really is a lot happier when she knows what's going on and can meet the people that I'm doing business with and form her own opinion of them. And often she has some real insight into these relationships and into these people that I might miss. So I find her a valuable partner, despite not being a traditional like business partner.
Yes, same in here. I'm pretty much sharing everything. So when we got together, she didn't know anything about investing, private equity, bonds, securities. Now she knows a lot. She knows the interest rates. She knows different industries. She knows different people I'm interacting with, having podcasts with. She listening some of those. So it's been a great journey, and I'm really living the life with her.
That's beautiful.
Next one, number 7. Your most important mission in your 20s is to surround yourself with the most talented people in the world in your chosen craft and learn from them. Go find them wherever they are in the world and figure out the way to give them some value and earn their respect.
A lot of the people I do business with today, or that I respect the most, actually wide variety of like wealth levels, but like fundamentally, it was all from my 20s, and it was actually, even as a slight addendum, I think do something interesting. I founded a moderately interesting company in my 20s, and that unlocked an enormous amount of things. That was my ticket to go to the TED conference, and I met a number of people at the TED conference who've been really successful entrepreneurs who've been collaborators for a long time. That was my ticket to the Scholl Scholarship at Oxford, where I met a bunch of interesting people. And so I think like saying yes to these sort of places where successful people gather, various event series. Honestly, Burning Man is that even. But there's ones I go to. There's Summit series. There's called Baby Bathwater, this Skull World Forum for Social Entrepreneurship at Oxford. It's more post social impact focused. So I found that those places where interesting people doing interesting work gather are probably the single biggest accelerators that I've had in my life. And sometimes people feel like, oh, I don't deserve, like I have to put the win on the board before anyone will take me seriously. And I find that not to be true at all. Like if you're earnest and you're smart and you're willing to listen and you're building something, like I feel like a lot of people will give you time and energy. And like in the other, like I said, the other one, like older people want to be in touch with what younger people are doing, and they want to be in touch with what is being built in new technologies and new business models. And certainly, even that they're just more youthful building energy. Like I could just build more in my 20s and 30s than I can today, just from a pure like output perspective.
Another one, you don't need to have kids in your 20s, but don't wait too long. It is the greatest joy of life. You get to choose your own adventure with kids. If you want to travel the world and go to Burning Man with your toddler, they're happy to be along for the ride.
Yeah, I think that's the like of the other things I'd put on a billboard. It's like so many people have this idea that they have to do everything right or their kid will somehow turn out wrong. Like they have to put them in just the right preschool and they have to put them in just the right kindergarten, and then they have to they have to do all these things. One of the single smartest, most successful people I know, she went to Cambridge. She started some successful companies. Her mom homeschooled them in the Botswana bush till she was 15. And then she finally went to a formal school. And it just I think that parents think they have to give up their life, and what I would encourage them is actually to double down on living like whatever life they want to live, whether that if that's a very you stay in one place, you do the same thing every day, then great, do that with your kids. But for more adventurous people, sometimes the kids can feel like an anchor if you don't actually solve that problem of how do my kids have the adventurous life along with me. We just had our shareholder event, and I took my kids out of school for 3 days to come to the shareholder event. So they're probably the only people there under 25, and I 11 and 14, and I gave them each a financial incentive to come to the talks and to give me a written summary of what was discussed at each of the talks. And so sure enough, they're both sitting there with notepads out, taking notes when I'm talking to Moses Kagan or when I'm talking to Eric Jorgensen. And, I think that is formative for them. I think they'll probably grab some little pieces of that. And I give them another financial incentive to go talk to people at the shareholder event and ask them what they do for a living and ask them if they have any advice for them. And so of my two children, my daughter completed every objective and then invoiced me for the $100 promptly via iMessage. My son, I've had to bother 2 or 3 times to give me his written work. So I think we know who's taking over the family empire, if there is one. But both very good kids nonetheless.
That's good stuff. Last one on this list. Don't stress too much about getting older. It is great. You will never be too old to road trip with your friends, make new friends, learn new skills, start new companies, invent new technologies, reinvent yourself, get stronger, get healthier, get wiser.
Yep, I should read that to myself every day. I mean, it's I took a road trip in the Balkans with my buddies a couple years ago, and one was in his 50s and one was in his 60s, and we were just like 3 guys in our 20s. It's just the same mentality. We went mountain biking, we had swimming in lakes, went to old like Yugoslav Air Force bases that are abandoned, ate great dinners, and all the stuff. Talked about life, and I think it's like, hey, that we made that a priority, and I will never, I'll never forget that. It was just such a memorable trip and a memorable time. So I think a lot of people resign themselves to old age, and frankly, I see this in my dad, and it's a little bit of a rebellion in some ways on my own part. He'll always often, oh, I'm so old. Oh, I can't do that. I'm too old. And it's a mindset, right? It's like I just I just got my name on on a patent, hardware patent, and so I'm still trying to be actively involved in like invention of things, not just like I'm going to do the same thing, this thing I know how to do again and again and again, which can sort of make you money sometimes, but can be cannot form as many new neural pathways, let's say, because that's what happens. Right? As we get older, like our brains get more rigid, they get more optimized to whatever function they've been trained on, and that neuroplasticity is very, very important as you get older.
Awesome. So we covered this list. I have another one for you, the one you put together. Now we go hardcore business, entrepreneurship, buying businesses. These are pretty much your lessons and everything you have learned after 20 plus acquisitions and after looking at thousands. Same here. I will read them one by one and let's hear your comment on each. Owner-operated businesses are super efficient. Owner does 6 jobs. You will probably spend more time to professionalize.
Yeah, I think this is the single biggest learning I've found in buying small businesses, and this is not as true in mid-sized businesses, to be honest, because in mid-sized businesses tend to have a head of marketing and a head of sales and a head of operations, and small businesses often the owner is the only commercially minded person in the whole business. So often the owner sells the work and everyone else does the work. It's this very common configuration. Sometimes the owner is the master craftsperson. They're the only one that has a vision for what new products the company could build, or they're the only one that knows like the quality bar that needs to be achieved. And all those things are very, very hard to replace. They're very hard to find someone else who has that. I find I've spent a lot of time with technology entrepreneurs, including ones that have built very valuable companies. And I've spent a lot of time with small business entrepreneurs who built plumbing companies. And the mentality is actually shockingly similar. The plumber who went out and built his own plumbing company is a different mentality than most plumbers. They're an entrepreneur. They're creative. They see opportunity where other people don't. They take risks that other people don't. And so often it's all the risk taking, all the decision making. There usually isn't a formal org chart, or often there isn't. So essentially the owner has 30 direct reports in some of these businesses. And so, you can come in superficially and say, oh, I can see all these opportunities for improvement. We can build a sales force. We can do marketing, but all those cost money. And those weren't in the earnings that, you bought, because you bought the earnings of a very, very efficient business where the owner does lots of jobs. And maybe you said, oh, well, we'll hire a general manager to replace the owner. But I've very rarely seen that actually work, where the general manager is as entrepreneurial and skilled as the person who's dedicated their life to this job. So I think it's both the biggest risk, but also the biggest opportunity in buying these small businesses is understanding how are we going to transition from the owner, and how's that going to work.
Another one, only buy from people who have demonstrated values of honesty and integrity throughout the process.
Yeah, this one I won't name which ones they are, but I've of all the transactions we've done, I have 2 I definitely would not do. And both of them, if I had looked closely enough in the process of buying, I would have seen something about the person that just didn't sit right with me, is the best way I can say it. One of these people was especially kind of sexist and would make lots of like kind of dirty jokes about women and that sort of thing. And, we kind of put up with it, because we wanted to get the deal done. And, but sure enough, the culture issues go very, very deep in these businesses. When the owner is toxic, then people who stay at that business tend to be people who can tolerate a toxic owner. And usually those are people with a lack of self-confidence, a lack of their own value. And so if you're going to then ask people without self-confidence and without a sense of their own value to step up and take responsibility for the business, well, they've never had to do that. In fact, there's kind of adverse selection. If they had that, they would have left this company a long time ago. And so, on the other hand, we've bought businesses from people who have just been absolutely wonderful humans, and they've been wonderful to deal with after the fact. If there's any issue that comes up or anything about their earnout or anything else, then they're just incredibly easy, reasonable people to deal with. And they want the best for the business. They want the best for their employees. They tend to have really like good, earnest, hardworking people who are loyal to them working for the business. And those have kind of had more positive surprises, where once we've gotten the business, we found, oh, there's actually a lot of talent here. There's a lot of depth to this talent. There's there's a really good culture, really strong culture. That's probably something you can't spend enough time on. Try to get the owner to have a few drinks with you and see what they say when nobody else is listening, and see if that's the sort of person you want to. You're in business with them, even though you bought their business. They're essentially like a business partner of yours.
Stock purchases should be at least 25% cheaper than asset purchases. You can't write off the acquisition price, plus you assume historical liabilities.
Yeah, so this is something a lot of people don't understand, and they just wave it away. Stock purchase versus asset purchase, but they're very different transactions. Stock purchase, you, at least in U.S. tax law, not sure how it works everywhere else, but in U.S. tax law, if you buy assets, you can depreciate them either quickly if they're a physical asset, or if you're buying the goodwill, it can be amortized over 15 years. With stock purchase, you don't have that. So you don't have that tax shield. So you actually have a lower effective cash yield on the business. EBITDA ignores taxes, which you shouldn't do, because taxes are real money that you really have to pay. And understanding the after tax earnings of a business that you buy is something that's really important. I think in EBITDA, the only things that really should be deducted, interest can be deducted. That's fine, because that is a financing expense, and that's depends on the deal. Amortization is truly a not non-cash expense, because you don't have to re-amortize something. But depreciation and taxes are real costs that the business will really have to pay. If an asset depreciates, you'll eventually have to buy a new one, and you better be putting some money away to do that. So anyway, I can go way down the EBITDA rabbit hole, but basically these assumption of prior liabilities as well in a stock purchase is something that's incredibly expensive and hard to truly diligence, and you probably never can, because you don't know what contract the owner may have signed with someone else that they just didn't produce in diligence. And maybe they forgot about it. Maybe they're hiding it. But then someone can come back 2 years later and say, well, your company owes me $1 million, and here's why. And, oh, you have some indemnification. Okay, well, you really want to go through a large lawsuit to try to get the seller to pay that? That's incredibly hard. So I rarely recommend a stock purchase for smaller businesses. There are only a few exceptions, but almost always. Sometimes the seller's accountant will come to you and say, well, they'll make more money if they do a stock purchase. And you may just have to say, I'm sorry, like this, we're going to do it as an asset purchase, and they're going to make what they make.
Mentioned EBITDA. Number 4, there is an adjusted EBITDA, and cash flow. Look for cash flow.
Yeah, single biggest learning for sure. There's some businesses that EBITDA essentially equals cash flow, which are easy to understand, because there's very little capital investment required. There's, if any, there's little need to reinvest to grow. That's where the money goes if it doesn't go out as cash flow, right? As you have EBITDA, but the CEO's always got plans to spend $2 million next year on this new marketing initiative, or that new plant, or this new product design team, or whatever. And so it never ends up turning into cash flow. It's always kind of kicking down the road. And we really try to focus on true free cash flow, because we feel that, especially where we have multiple businesses, we want to make those allocation decisions consciously. We want to consciously put money back into a business rather than just have it kind of hidden in the P&L, if that makes sense.
Next one, look for rich owners.
So there's another really easy heuristic. There's actually a lot of small business owners that are not that rich. Again, because they have good years, they have bad years. They're always reinvesting capital in the business. They're always buying new equipment. And so their sale is really the first time they've gotten a windfall from the business. Whereas other small business owners, you'll meet them and they'll be very rich because, like, when the business has a good year, it has a really good year. And there's some years where they make, 2 or 3 times the normal earnings. And also that business has been doing that for a long time. And so it's often something that shows some of them may be rich but very modest. They may live very modest lives. I think especially true in Nordic countries. But you can usually still tell. And certainly, if you request a longer P&L history from them, a 10 or 20-year P&L history, you can also see how much cash has gone to the owner.
Another one: look for businesses that have survived multiple economic cycles.
Yeah, this is another big one. Many businesses are businesses that thrive in a boom and have real trouble surviving in a contraction or recession. They're a classic one would be something like things related to new construction. So, businesses that focus on new construction trade at really low multiples, at least in the U.S. market, whereas ones that focus on kind of maintenance and service trade at much higher multiples. And I think that's a very correct assessment of the durability of both, because the need for maintenance and upgrade and repair is going to be there all regardless whether as economies tend to build a lot of new houses when interest rates are low and the economy is booming, but they tend to not build many new houses when there's at least in the U.S. when there's a contraction or when it's harder for people to get loans to buy houses.
Another one: make sure you're not in commodity business.
Yeah, so a lot of business models are just not very good business model. They're not that you can eke out a 10% profit if you run a really, really good operation, but they're just fundamentally challenged business models because if I'm selling bushels of corn, well, I can get those anywhere. And so, I can get them for the lowest price anywhere. And so, the more you can sell something that's actually differentiated, I think the better you do. And there's of course many ways to differentiate, but low price is probably the least durable of those, and probably one that plays least to the strengths of a small business too, because you don't have the economies of scale to drive true low cost. And so things like specialization, customer service, on-site expertise in a niche, those are all things where the customers are much less price sensitive.
Next one is very interesting. Everything is negotiable. We have done 90% seller financing 3 times.
This is one thing people really don't appreciate. And I was talking with someone else about this, where I think that, if I meet you for the first time and you can say, "Oh, Xavier, I really like this business you own. Hey, would you mind seller financing the whole thing to me?" I say, like, "No, I don't know you." Like, so people will try to just pitch it up front rather than, building that relationship and getting to, helping them understand your position as a business buyer, helping them understand what you'll do with the business. If they like you and they think that, like, they also think your ideas for the business are good ideas, then the conversation is much easier, especially with smaller companies, especially in Europe, to say, "Hey, it's hard to get a bank loan to do this. Like, it's going to be really hard for me to get a loan. The interest rate's going to be really high. They're going to make me sign away my house, all these things. Wouldn't it be a lot simpler if you were the bank and I paid you interest and, and if I screw something up, you can call your loan and take back the business. But otherwise, I'm just pay you out over time." And truth be told, a lot of smaller businesses have been seller financed for a long time, from owner to owner. And I think it's a newer trend in the U.S. to use SBA loans and as that, as a way to acquire business. And I think an incredibly valuable tool. I think talking to my friends in Europe, I think there's many more opportunities for seller financing. And I think many many ways. It is the best for all parties because it really cuts out the middleman. And the bank doesn't really want to lend against this small business because they don't know how to run it, and so naturally their pricing of risk is going to be high. Whereas the perfect lender against the small business is the person selling it to you, because they know how to take it over again if they need to, and B, they probably have a good sense of what is needed for the business to be successful. And a lot of times they just want the business to be transitioned more than they even want to maximize price. Or sometimes they have a price in their mind they want to get, and you can often achieve that with seller financing, where with commercial financing, it may be very hard to get to the number that they want.
Next one, everyone wants a raise after you take over.
Probably the worst thing you can do, unfortunately, is give them a raise, because that will send the message that there's a new sheriff in town, and they want to please all the employees, and they want to do what the employees ask for. And so I think one thing we've gotten much more interested in as we've gotten better at this is understanding if the employees truly are paid a market rate, or if they've been at a below market rate for a long time. Because if they're at a below market rate, then that's only sustainable often by the force of will of the old owner, to be honest. And that can sort of break as the business gets more professionalized, because a lot of people are very personally loyal to the old owner. They have no loyalty to you as buyer. And so, if someone comes knocking and offers them a 20% raise to switch companies, I think it's one of the greatest risks, especially in personnel-heavy businesses, that a whole group of employees leaves, and that it's hard to replace them. They're hard people to replace. So I think you want to see that the owner has been regularly increasing compensation of their employees. You want to try to understand if they're compensated at a reasonable market rate, and if not, make contingency plans for that. Because it is a big challenge. And it actually, we've had businesses where we came in and we gave, everyone healthcare, and that wasn't, in the P&L before. But we felt it was pretty essential, just as like a basic condition of working. And that reduced the profits by 10%, the business right there. So you're already digging yourself out of the hole.
Make sure management only gets paid bonuses when they distribute cash flow to owners.
Yeah, this is the other one you can put on a billboard. There's a huge incentive to set incentives on anything other than shareholder distributions, because frankly, it's easier for management to achieve, and it gives management more flexibility. But you don't actually want that. You want it to be, hey, we have an amount of money that you need to either send to us or use to pay down the acquisition loan. That we kind of treat those as interchangeably. What we do is we just have a separate bank account that they don't have access to. And, basically a target, you need to send this amount of money to this bank account this year. And if you send more than that, you get you get a really nice bonus. If you hit your target, you get some bonus. If you send less, you don't. And it's an incredibly simple metric, but it focuses them on what they really need to do, which is ultimately take care of their shareholders. And that's the hardest thing to get aligned, is make sure that the people running the business are thinking of the shareholders, not thinking of the customers, not thinking of the employees, not thinking of themselves, as much as they, of course, should think about those things. They are ultimately working for the shareholders, and so that should be their first priority, is making sure whatever the shareholders' goal is actually happening.
Pay for a really good but very efficient lawyer.
Yep, it's incredibly expensive to pay for a mediocre lawyer, because they will miss things that could come back later and cost you a lot of money. So experience really, really pays in law, and you'll be able to see really quickly. I find with lawyers, it's actually as much the small things as the big things. Do they spend 5 minutes talking about the weather and then bill you for it? Do they, respond briefly, or do they write you, 10 paragraph emails when you ask them a question, or do they respond with a quick thing? Do they stay on the phone with you for 2 hours, or do they stay on the phone with you for 10 minutes? There's a huge range in that. And in a profession that bills by the hour, all the incentive is actually to stay on the phone longer, to write longer emails, to make more trivial edits to legal documents. And there are some lawyers who are conscious of their customer and actually focus on efficiency. And you see it in their communication style.
Pay for quality of earnings even on small deals.
Yeah, this is another one that I would put on the billboard. We've found a lot of things when we do the quality of earnings, and often they're just nothing malicious. It's just that the accounting is never that good at these companies, and so you have to take any financial statement you've seen and assume that it's wrong. And the only way that you can verify that it's not wrong is to get good accountants to go and basically rebuild it from scratch based on actual cash flows. And so I think I actually find it very helpful to look at the bank statements myself as a buyer and kind of just notice, oh, what is that bill? Why do we pay that $5,000 bill every month? And you look at it with that lens, then it starts to get you curious about what those expenses are and why we pay them. And it's one thing to see them in the financial statement, but it's another thing when you have to write that $5,000 check every month.
The best way to find the CEO for a business is to ask the seller who has asked about buying it in the past.
Yeah, that one has worked for us twice, both times with great success. And as it tends to be someone who knows the business, who likes the business, who could see themselves running the business, but often they don't have access to the financing, or they wouldn't know how to fully take the deal from end to end. And they can be a true sort of partner, which again, if you're not going to run the company yourself, you want the most aligned possible partner running the business, ideally who has upside and downside risk alongside you, ideally who's also focused on cash flow. Or if you're growing the business to resell it, then maybe on different metrics, right? Maybe on EBITDA growth or whatever else it is that you're, as long as you're aligned. I don't think it matters on what exactly, but that that alignment is really key. And I don't know if it's in this list, but I find the more that someone could share downside risk as well as upside risk, the better focused everyone's mind is on the same thing.
When exactly do you ask this question from the current owner?
I right now ask it up front. So right now, what I'll say is basically, I'm not going to run your business. And some HoldCo folks, that may be different. But for me, I'm very explicit, and I say, look, we are not in the business of running this business, and we frankly don't think we would be the right people to run it anyway. So for us to buy a business, we need to know who's going to run it, and we need to know we need to believe that they will be successful running it. And so that will often be an open conversation but it's surprising the number of times that the owner will immediately think of someone and suggest that you talk to them.
Look for smallest, weirdest niches, less competition, greater margins.
There's no such thing as a too small niche in this world. There really isn't. Almost everything is better in the small niches, and the single best deals I've seen have been in the smallest, weirdest niches.
If you find a good enough deal, the capital will find you.
Yeah, this is the other thing that is very hard to believe. Sometimes I still don't believe it. Like I wonder, okay, if I had to go raise $50 million tomorrow for a bigger deal, we don't have that on our balance sheet. We can't just write that check. Could I do it? And what I know to be true, if I reflect on all my experiences, absolutely I could find that money if the deal is good enough. If it's a marginal deal, I will really struggle. I might not be able to raise it. If the deal is good enough, everybody wants part of it. And and that's sort of what happened with I don't know if you saw Nick Huber raise the money to buy Shepherd. He had to raise about $20 million. Once those of us who got under the hood of the deal really got under the hood, great CEO coming in, Nick's heavy involvement, drawing traffic to the business, and already incredible performance, as well as Sean, the other big shareholder, rolling over. When you added all those up, it was a really, really good deal. And pretty soon people were fighting for allocations in the deal rather than like Nick not being able to raise the money. It went from one direction to the other very quickly.
Before moving on with the list, I'm asking a few questions about this acquisition, if that's fine. You posted 2nd of May that you made this investment into Shepherd. I think now it's called Somewhere. And
yeah, it's called Somewhere.
And you mentioned number one, Nick's one of the best entrepreneurs we've ever met. Number two, Somewhere solves a universal need, better talent at lower cost. And number three, Petar, the CEO, is amazing. Two questions. What makes Nick one of the best entrepreneurs you've ever met? And did you have to convince the... Okay, let's leave it like this. What makes Nick one of the best investors you've ever met?
So what makes Nick so good is that Nick knows how to build an audience and he knows how to sell to the audience. Those are two very different things. I have a lot of other friends who have a big audience and they're really hesitant to sell to it, sometimes for good reason. Nick is shameless and in the best possible way. And so he's built that into his personal brand that he will shamelessly promote things he's involved in. And he will do it in a very creative manner. Nick has tweets about how his son hired a VA from the Philippines to do his homework for him, and of course, all these people on Twitter will see that and they'll be, oh my God, that's terrible. How could you do that as a father? And they'll get into arguments. And of course, all that's amazing for the distribution of the tweet, right? And all Nick wants people to do is get that in front of small business owners who will say, what, you can hire someone for $5 an hour? Really? And so Nick also is a very compelling salesperson to executives. Nick's very clear that he's not going to be running the business, but he's very good at identifying talent that wants to work with him. And they really see in Nick something that they don't have themselves, right? So Nick's ability to build the audience and sell to it is something that most entrepreneurs don't know how to do. Most CEOs don't know how to do it. And so with Peter, we have a very, very good operational CEO, someone who's scaled businesses past 100 million in revenue, who is from Bulgaria. He intimately understands the incentive to offshore or nearshore employment, a real execution machine. He can never do what Nick does. And so it's really the combination of those two that made it so compelling from our view and made us think, hey, if this thing works, even if it just stays where it is, we have a really nice ROI. But if it gets as big as it could be, this could be a really, really, really big company, because you look at just one fundamental fact of how big the US economy is, and that for any job that does not require someone to be physically present, there is someone in the world who is cheaper and harder working than any US citizen who will for the same price. Like I think that's almost universally true. And it's not to say that, there's a bunch of incredibly hardworking, incredibly smart people in the US, and they're expensive. They're very expensive. And so when you take that kind of intelligence, drive, motivation, but they live in Colombia or Argentina or Philippines, the arbitrage is dramatic.
Okay, that's perfect. Thanks for giving the overview of why you decided to make the decision. Now, back to the list. Don't underestimate how little you know about any given industry. Find an expert to help you.
Yeah, there's a good phrase for these called river guides in the search fund world, and really, there's so many gotchas and nuances to any industry that you just will never truly understand. And you need as many people around you who understand that industry as possible if you haven't been in it. I think it's one of the biggest challenges of building a HoldCo is to really be able to get up to speed with an industry enough to decide if you want to participate in it. And some of the best groups I've seen, they do 3 to 6 months of research on the sector, talking to as many people as they can before they even decide it's a desirable sector to try to buy a business in.
Businesses with real estate offer lots of creative financing opportunities.
Yeah, we looked at one business where the owner had gotten very unintentionally. He had a printing business that was was moderately cash generative, and he had bought his warehouse, which ended up being in this gentrifying part of the greater LA area, and so he bought a warehouse that ended up being worth way more than the business itself was worth, and so we didn't end up doing that deal, but the deal to be done would have essentially been to say, look, I'll buy the warehouse for full price, give me the business for free. And because a real estate is a lot easier to finance than business acquisition is. And so the owner ultimately probably doesn't care as long as they get a certain amount of money in their pocket, and they get and often the amount of rent that the business can pay is somewhat variable. So the business may be able to afford to pay a little more rent than it's paying right now, which makes the real estate more valuable. So there's a really interesting interplay there. And real estate financing, much lower cost, much longer term. In the US, there's a special kind of SBA loan just for real estate oriented businesses. So there's a lot to be done with that.
Another one, an owner who works 10 hours a week is still doing five people's job. They are the world expert in their business.
This one, again, you may need to hire a whole director of sales and marketing to replace what the owner does at the country club, where they organically generate millions of dollars of leads by hanging out with the other general contractors or whatever it is they do. And I think you can really, because it's a common pitch from the business broker, like, oh, the owner barely comes to the office anymore. Well, yeah, but any big decision still goes to them. Probably any big deal is closed by them. And those tend to be the highest leverage activities in a typical smaller business.
I would add here one thing or one question based on your experience. When acquiring a company, pretty much making the owner rich, have there been any cases where the owners still keep running the business or you haven't done it?
Yeah, we've had some. We find that two things are true about that. One is that nothing actually changes. So whatever good ideas you may have to change or modernize the business, you really can't count on those happening without a change in management, and that may be fine in many cases. Especially with younger owners, sometimes they need to take some money off the table, or they want some growth capital, and those can often be really good partners because they actually want to grow the business. If anything, they need a business partner to help them. I would say we've been doing less deals with retiring owners and more deals with growth-minded owners who own a business that's at a certain stage, and they want a financially minded business partner in the business, and they are actually distributing cash flow and growing, but they have a lot of energy and a lot of room to run. And I think those are really good situations, because I think like the biggest risk in any business is leadership transition. And so the practice of buying businesses from owners can be very profitable, can be very successful, but has that additional degree of risk where if you have someone who's already proven that they can run this particular business and they just wanted some help getting from A to B or B to C, or they need a partner bought out, or they need some lenders bought out, or something like that, those can be really good situations.
Professionalizing a business with no management in place is probably too hard unless you are running it.
Yeah, I think that's very true. I would be more and more skeptical. We had some deals early on where we were willing to take that on, and I think I would only do that now in very, very rare circumstances, because it is just is a lot of work. And what I would do in those circumstances is I would only focus on finding the CEO. I wouldn't focus on finding VPs of anything or anything else. I would just focus on them. And for some CEOs, they'll just run a very lean company and they won't have VPs, they won't have a middle management layer, and that can work really well sometimes.
Understand the working capital situation deeply, and as a first order of business, the working capital adjustment can be a huge adjustment in price.
Yeah, we've had multi-million dollar swings of that number. And often there's reasonable positions on both sides of a negotiation on that. So it really is. If you're not like, I'm pretty good with finance, and I sometimes still need to pull in, an experienced accountant to look at it with me. Um, but I think what you're really ultimately trying to get to is you're saying, look, there's a common view in small business owners that says, well, hey, when I sell my business, I'll just collect all the invoices for the things I've already done, and I'll pay all the bills, and then I'll hand you the business. And that doesn't really work if you have a business that has a big working capital need, because some, common example would be like a contracting business. At any time, that might have 2 million, 3 million, $5 million in invoices, and they sort of always have that. It's just a cost of doing business, and so these businesses that do have large receivables, or sometimes they have negative working capital. Sometimes they have a big payables, but they're able to extend it for one reason or another. Then, in software businesses, for example, often the customer pays up front for the year, but you have a liability because you have to actually deliver the software the rest of the year. And so that's something where the seller should leave some money in the business for, covering that deferred revenue, that revenue that they didn't earn yet. And so these are all areas that can cause, 6-figure and 7-figure swings in the actual amount of cash paid and the actual quality of the business you take over. Because your worst possible scenario is get that wrong, and then you find out all your customers only pay you for 90 days, and you have a cash crunch right after you take over the business. That would be the worst case scenario.
The last one on this list, don't fall too in love with the business. You've always got to be ready to walk away. I think it's easy to say, very hard to do sometimes. How has it been?
Very hard to do. Very, very hard to do. It's one of the hardest things about this business, because there can only be one thing wrong or one unacceptable risk. And, you have to give up months of work and a good relationship you built with the seller and a broker who's pressuring you to close, and you have all that stuff. And you have to make one tough phone call and say, I'm sorry, I can't go further. And I've made that call before. It's no fun. I have some brokers who are still grumpy with me about it, and they, it's just life. It's just part of this business. So I think some other brokers, I had one that we walked away from. We did submit an offer, but they didn't like the offer, and he liked us enough through that process. He gave us a really juicy deal a month later, just because he liked working with us. So it does go both ways. But yeah, it's never fun, especially when that seller is, they're already counting the money in their bank account. And I think sellers probably overvalue the LOI, and if buyers, once they're more experienced, they probably undervalue the LOI in the sense of the level of commitment. So like, yeah, for a buyer, it's like, okay, well, we're under LOI, now I'll do the real work. And for the seller, like, sometimes they're like, okay, well, we've got the buyer, now it's just about checking the boxes.
Xavier, I want to respect your time. Let's wrap up with the famous five. How old are you?
45.
Favorite book?
Oh man, jeez, boy, this changes all the time. I'll just give a fun one I love, which is Fight Club. The actual book, not the movie. I love Chuck Palahniuk's writing style. American Gods. I will do that one too. That's another fiction writer that I love. I like to read fiction. American Gods by Neil Gaiman, if you haven't read it, is spectacular.
What car do you drive?
I drive a Tesla Model 3 and a Nissan Xterra that was painted by an artist. It looks like an art car.
What's the best investment advice you've ever got?
Invest in things you understand and don't sell them.
Last one. Where can people find you?
They can find me on X. That's really where I post most of my stuff. I'm not an Instagram guy. I'm not much of a LinkedIn guy. So I'll be the last man standing on X. I think if as long as it works as a platform. And I also have two things maybe of interest. One is I just started on a platform called Intro. I really like it. You can find it in my X profile, Xavier Helgesen. You can actually book a call with me. You can just book book a call, you pay some money. That's really just to show that you're serious. Because if you do it for free, then anyone will do it, and they won't show up. So I find it to be a very good mechanic, and I've already met some really interesting people through it. And I'm going to start a sort of private membership group through Intro as well soon. It'll be $99 a month, so it'll be cheap. But the concept is basically 1,000 builders, so 1,000 people building holdcos or building companies in a WhatsApp channel, just providing mutual support, as well as other things like Ask Me Anything Zooms with me every so often, that sort of thing. So I want to have these. A lot of folks ask me advice because I've done a lot of different stuff in my career, and I think we've helped popularize this idea of building a holdco and buying business, and I think it's a really good thing for the world. So I'm happy to do more of it, and I've personally gotten a lot of value and support from being part of YPO, which I highly recommend to anyone if you qualify. But it's a pretty high bar. You have to be over, I think, 10 million in revenue or maybe more now, and it's expensive. And so I'm also part of what I'm doing with this club is trying to bring some of the benefits I get from YPO to kind of a more accessible price point and interface. So more to come on that.
Okay, Xavier. Again, I can't thank you enough for doing this. This 60 minutes went by very quickly. I did the intro call with you, $100 very well spent. So I suggest others to do that. And again, thanks so much for doing this, and thanks so much for putting out great content. Otherwise, I would not be able to do this podcast because this was quite easy to prepare.
Okay, Mick. Well, when you find one of these beautiful businesses that checks all these boxes, you know who to call to invest alongside you.
Sure, I will.
Don't be a stranger.
I will. Thanks a lot for doing this.